In 2021, something happened that many people believed would permanently damage Bitcoin. China, a country that once controlled the majority of Bitcoin mining, suddenly announced a nationwide ban on cryptocurrency mining. At the time, China was not just another player in the crypto world. It was the center of global Bitcoin mining. Entire regions were filled with massive warehouses running day and night, securing the Bitcoin network. When the ban was announced, panic spread instantly. Prices dropped. Analysts warned of security risks. Critics declared this was finally the event that would break Bitcoin. But what followed didn't destroy Bitcoin. It transformed it. Why China banned crypto mining? China's decision to ban Bitcoin mining was not random or emotional. It was strategic. Officially, the government cited several reasons. One was financial stability. Beijing viewed decentralized cryptocurrencies as a threat to its tightly controlled financial system. Bitcoin allowed money to move outside government oversight, something China was never comfortable with. Another major concern was energy consumption. Bitcoin mining uses large amounts of electricity, and in China, much of that power came from coal-based energy. As China pushed toward climate targets and carbon reduction goals, energy-intensive industries came under pressure. Mining quickly became a target. There was also a political motive. China was preparing its own digital yuan, a state-controlled digital currency. Bitcoin represented the opposite philosophy: open, decentralized, and uncontrollable. Removing mining helped clear the path for China's own digital financial future. In short, Bitcoin mining didn't fit China's long-term vision, economically, environmentally, or politically. The immediate impact: panic, price drops, and hash rate collapse. The effects were immediate and dramatic. As news of the ban spread, Bitcoin's price plunged. Traders panicked, fearing that the network had lost its backbone. Headlines questioned whether Bitcoin could remain secure without China's massive mining power. And the numbers were shocking. China's share of Bitcoin's hash rate, the computing power that secures the network, collapsed almost overnight. Estimates showed it falling from roughly 65 to 70% of global mining power to nearly zero. Because hash rate is directly tied to Bitcoin's security, this raised serious concerns. For a short period, the network slowed. Transactions took longer to confirm. Some critics argued this was proof that Bitcoin was fragile and dependent on centralized infrastructure. But what they didn't understand was how Bitcoin was designed to respond to exactly this kind of shock. The Great Mining Exodus. With mining banned inside China, miners had only two choices: shut down or move. Most chose to move. Thousands of mining machines were packed up and shipped across borders. This wasn't a small relocation. It was one of the largest industrial migrations in modern digital history. Many miners moved to North America, especially the United States and Canada. These countries offered clearer regulations, political stability, and access to cheap or excess energy. States like Texas became hotspots due to flexible energy markets and abundant power supply. Others relocated to Central and Northern Asia, including Kazakhstan and parts of Russia, where electricity was inexpensive and governments were initially welcoming to mining operations. This mass relocation took months. During that time, the Bitcoin network automatically adjusted its mining difficulty, allowing the system to continue functioning even with reduced hash power. A stronger, more decentralized Bitcoin. Within a year, something remarkable happened. Bitcoin's total hash rate recovered, but it didn't return to its old structure. Instead of being concentrated in one country, mining power was now distributed across multiple continents. The United States emerged as the largest mining hub, but no single country dominated the network the way China once had. This had a powerful effect on Bitcoin security, A network once vulnerable to a single government decision became far more resilient. No single country could now shut down mining and threaten the entire system. This geographic decentralization strengthened Bitcoin in a way no software update ever could. Ironically, China's attempt to weaken Bitcoin ended up hardening it. How mining reshaped energy markets. The mining shift didn't just affect Bitcoin, it changed how energy markets viewed crypto. Mining operations require massive electricity, and as miners relocated, they became major customers for power producers. In places like Texas and Alberta, miners began using surplus electricity during off-peak hours. Some mining operations even agreed to shut down during grid stress, helping stabilize local power systems. This created a new model of grid-responsive energy consumption, something utilities had never planned for. Renewable energy projects also benefited. Miners helped monetize excess wind and solar power that would otherwise go unused, improving the economics of renewable infrastructure. Institutional attention and long-term effects. As the network stabilized, large institutions took notice. Investment firms began tracking Bitcoin hashrate distribution as a sign of network health. A mining network spread across stable jurisdictions was seen as a positive long-term signal. Energy companies, once skeptical, started treating miners as industrial partners. Some even invested directly in mining operations to profit from unused generation capacity. What began as a ban in China evolved into a global restructuring of Bitcoin's physical infrastructure. The bigger lesson. The 2021 China mining ban was never just about mining machines or electricity use. It was a test, not of China's power, but of Bitcoin's design. China expected that by cutting off miners, it could weaken Bitcoin's influence, slow the network, and scare the global market. In the short term, it worked. Prices dropped, hash rate collapsed, confidence was shaken. But in the long term, the opposite happened. Instead of shrinking, Bitcoin spread. Mining didn't disappear. It moved across borders, across continents, across political systems. For the first time, Bitcoin mining became truly global. No single country controlled the majority of hash power anymore. No single government decision could threaten the entire network overnight. Energy systems adapted too. Miners didn't just consume electricity, they learned to fit into energy markets. They absorbed excess power, they shut down during peak demand, they partnered with renewable projects that couldn't survive without constant buyers. This forced regulators, utilities, and institutions to look at Bitcoin differently, not as a speculative toy, not as a fringe experiment, but as digital infrastructure, something that interacts with power grids, capital markets, and national policy. The ban also taught users a deeper lesson. Bitcoin's strength does not come from price. It doesn't come from miners. It doesn't come from exchanges. It comes from decentralization. Real decentralization, tested under pressure. Bitcoin didn't just survive the ban, it adapted, it reorganized, it became harder to kill. And that is the real story. Every major system is defined by how it responds to stress. In 2021, Bitcoin faced its largest coordinated shutdown attempt ever. It didn't collapse. It grew up. Not because it was protected, but because it was designed to be impossible to control. A network that can't be stopped, China banned Bitcoin mining. Bitcoin didn't disappear. It adapted, redistributed, and became stronger. This event proves something fundamental. Bitcoin is not secured by any country, company, or government. It's secured by math, incentives, and global participation. The ban didn't end Bitcoin's story. It reshaped it forever. If you found this breakdown helpful, like the video, subscribe, and turn on notifications for more deep dives into the moments that shaped crypto history. Bitcoin didn't fall in 2021, it evolved.